Good morning, everyone, and welcome. Let's get started here at the Creative Bird Strategies Podcast, live every Sunday morning, 9 a.m. Eastern Standard Time, providing education, networking, and strategy. My name is Joe Scarice. I'm a co-founder and co-host of this great podcast, along with you, Mr. Yardell Perkins of Perkatech. We're rocking and rolling, going into the 100th plus episode. Right now, we're actually scheduled out as far as we're probably almost scheduled out to the mid-November level right now with subject matter. I'm really proud to say that it's a different subject every Sunday morning, providing insight, scaling opportunities, strategy opportunities. I'm just really excited about where the podcast has gone. We're now averaging somewhere between 3,000 and 4,000 views every week for real estate investors and real estate professionals nationwide. So it's quite exciting where this once started. We were just kind of like throwing things around, and now we legitimately have a scheduled process. We have a following, and I want to thank everybody for that because it's very humbling, and I really appreciate that. So we're going to dive into our subject today in just a few minutes. I'm pinging some people in that are on Clubhouse as well. Today's discussion will be breaking down shifts in the market, mid-year update. We're at the mid-year, give or take, a lot of things moving around. First and foremost, happy Father's Day to all the fathers out there. Happy birthday to the Army, celebrating their 250th year. So I'm very excited about that, reading about that as well. And so a lot of things going around in the market this week. Very busy week, a lot of activity with real estate investor inquiry. A bunch of great events we just had this past week as well. So we'll dive into, first, let's talk about the past week, what we had here. We were in Philadelphia, and we had a great discussion on landlording on Monday. Tuesday, I was at the Delco Property Investors, which is a more grittier subgroup of the Delaware County market in Philadelphia, outside of Philadelphia. About 60 people, very active, talking about AI and how to apply it as a real estate professional or investor. Then Wednesday, we dived into Lehigh Valley. We had one of our best networking groups to date. We had a really almost a full house of room of real estate investors. Thursday night, we had a great happy hour up in North Jersey with another group of investors. And then we dived into finishing off the week here back in Philadelphia for a networking event, more of a educational type of environment on Saturday. So a lot of meeting and greeting a lot of people, putting a lot of loans in, a lot of discussions, anywhere from single family to 4-family, multifamily, a lot of fixed to rent, a lot of fixed to flip. Money's dropping in the construction money still. It's still very low in the 8s now. And then DSCR is kind of holding its own. It's kind of shameful what's going on with the Fed, with what's going on with their inactivity or stagnation. But let's first recognize our sponsors, of course. Always love to thank Mr. Yardell Perkins of Perkatech, who provides our social media architectural work, social media designs, graphic work, administration for all our marketing. I'd like to thank Glenmark Capital, where I am a senior loan analyst providing nationwide asset-based lending for real estate professionals throughout the country in a DSCR space 1 through 4, 5 through 20. Then obviously fixed to rent, fixed to flip. Really don't have a ceiling there on how many units we could look at. We're a portfolio lender where we could blanket loans. We'll look at new construction as well. General construction lines of credit. And then I'd like to thank MB Capital Solutions, where I'm a referral partner in the unsecured business line of credit program, providing unsecured business lines for real estate investors nationwide. I'd like to thank Ms. Linda Pelagas of Really 411, who provides a national publication and national events for her real estate professionals that follow them. And then we've made some moves a little bit on our networking groups. I'd like to thank, we just put together a new group for all the events that we're holding now in Connecticut, Delaware, New Jersey, Pennsylvania. It's going to be like 8 or 9 events a month or quarter. It's called Real Estate Mastermind Strategies. And then also I'd like to thank TCS Property Management Services, where my real estate licenses are currently held. for New Jersey and PA, and where I also base my CE instruction courses on asset-based lending throughout the country, where I provide CE 2 or 3 credit CE courses for real estate agents nationwide. So let's dive into our articles that are a little more updated to the market. The Fed, I don't know what the hell their deal is, but I mean, they're becoming less and less relevant to the market activity. Rates kind of closed out at 6.89 on the 30-year, 10-year rate. Rates on the commercial side, quite relevant. Not much to change there as well. We might see a slight change this week on DSCR. Might drop an eighth or to a quarter, probably in the high sixes, low seven, depending on what you're trying to accomplish, whether it's a purchase or refi. Construction money has held tight at around 8.99 to 10%. So that's kind of held really tight on the market as well. Let's see here. Let's see if anything it catches my eye here. There's talk of trying to create a single credit report model working within the mortgage industry because there's such varied scores depending on where you do your background check on the clients. In the non-QM space, it's traditionally just a soft pull. You only look at a hard pull in our space when you're working with a regulated bank or a broker. So please keep that in mind when you're, as an investor, you should keep in mind that a true direct lender is only soft pulling your credit. A broker or a regulated banker is doing hard inquiries. So you got to keep that in consideration when doing work with your credit report, because obviously the more the inquiries, the more volatility there might be with your credit report. So that was an interesting article. I posted that information this past week as well. Let me see here. I'm just trying to get some people invited in here that I see down below. But again, let's dive into some articles. Record investor home sales present opportunities for buyers. We are in a full-blown buyer's market. Depending on what market you're in, maybe it's slightly seller's market in certain areas, but right now we're seeing some inventory hit the ground here, and what I'm seeing also, what the real estate investors doing, they're calling agents correctly and trying to peel the onion. Even if that listing they're going after is not working, they're trying to build a relationship with the realtor more so than ever before. So that was a great article. I put that out this past week. Active listings hit a 6-year high in May. So, again, it is a buyer's market. We didn't really have much of a spring market. It was pretty just kind of lackadays. I think this is a unique opportunity for the investor. There's so much money to put to work on DSCR and fix to rent and fix to flip. I mean, unlimited amount of money to put to work. If you're not leveraging it with your lender, you're not doing enough work and opportunities for yourself. So that leads into our discussion today, and then we'll open it up to moderators, of course. And I put a couple points that really catch my eye, breaking down shifts in the real estate market for real estate agents and real estate investors. Key shifts are happening in the real estate market that agents, investors need to monitor closely in 2025, along with how to adapt strategically. Higher for longer interest rates. What's happening? The Fed is holding interest rates higher for longer due to sticky inflation. I feel like inflation is kind of coming back down. I think sentiment toward the consumer is actually, there's a betterment there. Impact on agents right now. You're looking at slower home sales, more price sensitive buyers, fewer first-time home buyers. So you're shifting around right now as a real estate agent what to do and what not to do. So there's some adaptation tips here. Focus on seller education, creative financing, working with more investors, or even identifying high motivation niches like divorces, probate, relocation. Investors, lock into longer term debt, exploring seller financing, even subject to deals. Inventory constraints and low new construction. What's happening there? Baby boomers are aging into place and builders aren't producing enough starter homes. Impact on agents, less listing and inventory to work with. Impact on investors, increased rent demand value add and rehab opportunities growing. I'm seeing more fixed rents being submitted this week than previous 2 weeks, actually. I saw probably about 15 submissions this past week. 3/4 of them were fixed to rents. The other quarter to 30% were DSCR. So, and then you have to keep an eye on migration and remote work still shifting demand. People are still moving to secondary and tertiary markets for affordability and lifestyle. How does this impact agents? Opportunity to build referral networks in inbound migration zones. Impact on investors? High returns, most likely in the Sun Belt, Midwest, and smaller metros. Adoption tips. Use tools like U-Haul migration reports or USPS change of address data target movers. Investors, explore midterm rentals and hybrid STR long-term rental markets. I'd be very careful with the pad split. Anybody thinking about pad split, guess what it is overall? It's a boarding house. Lenders don't like it. Be very cautious in how you show off your proudness with your lender. You could end up getting a loan turned down pretty quick. So, if anybody wants to have an off this market discussion about that, like off the Clubhouse or off this podcast, call me and let's talk about pad split and what you should do if you're going to decide on doing that. What's happening in I think AI is doing a lot of movement right now. I'm seeing major chatbots, like Yordell and I were reviewing this presentation yesterday, how an entire conversation with a real estate agent was done through AI. All the questions, everything's prepared for you. So you got to get caught up there. And I think there's going to be increased regulation and rent control discussions. I don't think rent control is going to go nationwide, but I think the inner urban cities are going to really push for more restrictions against the landlords and more in favor of the tenants. So I think you're going to see tightening of rent controls or tenant protection laws. Complex transaction guidance is needed for the agents for the betterment of their investors. And investors need to underwrite political risk and compliance. I feel like short-term and mid-term rentals are evolving. Got to kind of watch where that goes. AI and tech is reshaping transactions. And again, going back to what agents should be looking for, getting niches, divorce, probate, REO, expanding skills in creative financing, increasing tech usage, and target migration trends. The investor, you should focus on cash flow work markets, raising private capital, and mastering creative deals. Tracking political and regulatory shifts. These are some things just to get, the room thought and thinking pattern toward breaking down shifts in this market mid-year. That's what I'm seeing so far. I've never seen more conversations on AI in the last 2 months than the previous year. Okay, so keep an eye on that, because I think it's the adoption for you and working with people that are AI-centric is going to be very important in the opportunities that you're going to find. Bob, good morning. Welcome. Brief overview, who you are, what you do, and thoughts to a discussion, breaking down shifts in the market, mid-year update.
Hey, good morning, Joe. I'm Bob Kasich. I'm president of Chesapeake Corporation. I set up corporations and LLCs for people. I'm not a lawyer. I'm not here to give legal advice. Excuse me. So looking at the shifts in the market this year, and I think I talked about this a couple of weeks ago, but it's a pattern that's definitely continuing, is that I'm seeing a lot of people are becoming a lot more gun shy about making commitments and making decisions on purchases, or even just taking longer to pay bills. I know that I've had a discussion recently with a landlord in the past week who said that they've never before been in a situation where they have almost the majority of their tenants in a multi-unit property that just are simply defaulting on the rent, and essentially is going to force them to begin eviction proceedings. And other cases, even this past week, I had someone who was going to set up an LLC to put a property in. They got gun shy when they realized what it costs to set up an LLC in New York. There's people are becoming much more hesitant to make decisions and make commitments. And on top of that, the other trend I'm seeing, and it's something that my company is trying to adapt to a lot more, but with a degree of caution, as Joe said, the adoption of AI. The only thing I'm always going to say about AI, and this is something that I think some of the early adopters are missing really quickly: garbage in, garbage out. AI still initially has to be programmed by people, and people can put bad data in AI. So when you use AI to do something, not to mention the technology that frankly just isn't there yet. If you're using AI, that's great. It can take some of the more, shall we say, redundant tasks or tasks that just burn up your time and drill those down for you. But remember, don't assume that what AI is spitting out is 100% accurate. You still have to check it. You still have to verify your data. That's absolutely critically important. I've actually had a couple customers generate AI charters for LLCs. And they said, "Oh yeah, we just had the AI. We had whatever's built in Microsoft, whatever AI is built in Microsoft Word. I think Microsoft calls it Copilot. They had Copilot write them articles of incorporation. They were garbage. I said, I can't even submit this. It doesn't even meet the basic standards. And I said, if I put it in, I already know it's just going to get kicked back by the state. So, like I said, the AI technology, it's not all there yet, but people are adapting it quickly. So as you grow your business, find ways that it becomes useful for you and in some cases useful for your clients, but mostly useful for you. Is the way I would put it, because at the end of the day, people still want to work with you and know that you are the trustworthy person behind whatever tools you're deploying to run your business. Those are my thoughts, Joe. I yield it back to you.
Wow, thank you. And it's funny. I was watching a workshop yesterday in my office with John McAllister, who's part of the Sub 2 Owners Club community, and they sent out like 650 they did 650 calls to realtors using this AI tool, where saying, hi Bob, this is Joe, this is so and so looking to get some information on the property, and they were getting the people to answer the questions. Some of the realtors actually had their own AI answering the phone, so AI was talking to AI. It was so interesting, but they got like 30 leads out of that and had great conversations. And the realtors were the ones that they got on the phone, maybe a little topsy-turvy in the beginning, but then it started gelling. I mean, I really feel like the real estate investor today that's going after working with agents with properties and opportunities are going to break through these shifts. They're gonna, and I think the realtors that are being adaptable to the shift in the market are going to be fine. I think, like, I listened to this conversation that John had with one of the real estate agents. Hey, I got a couple off market deals coming online. These might fit what you're trying to do. Then John's like, hey, I do private money. I work with a direct private lender, because he's starting to white label my product. And all of a sudden, it's like peanut butter and jelly. John's in Philadelphia. He's calling people in San Antonio, Texas. Like, he just picked a market. And he's going to build relationships wherever he needs to build relationships. It's not going to be just because he's here in Philadelphia. And, for the remainder of 2025, I think real estate agents and real estate investors need to pivot strategically to stay profitable and competitive. I'm going to break down by role with tactical moves in response to current macroeconomic and market shifts. Like, for real estate agents, you got to double down on your listings. You got to educate buyers on creative financing, and even your sellers, right? Understanding non-QM, understanding assumable mortgages and seller financing. Shifts toward investors. You need to be more real estate investor friendly. The open house is just not going to cover it. Okay? Working with cash buyers, flippers, buyer and hold investors. Learn what DSCR is. Learn what BRRRR is. Understand rehab loan basics so you can speak the language. And then leveraging AI and automation, ChatGPT, MailChimp, higher level. Build a local content machine, market updates, neighborhood videos, short form Q&A content, Instagram Reels, YouTube Shorts. For real estate investors, maybe look at midterm rentals. Traditional Airbnb faces a lot of regulation and saturation. Midterm rentals for travel nurses, Business travelers, relocators are in demand. Look for Class B or C multifamily or condos near hospitals or business hubs. Buy with terms. Try to get the creative financing deal. Seller financing, subject to. Interest rates are still elevated. We're still at 7%, which is the national average. So there's a lot of people out there at 3-4% rate. They need to get out. Target tired landlords or pre-foreclosures. We had a discussion this Wednesday, and the gentleman gave a great idea. How about calling the real estate agents that have listings that are at 5 months? They're up against their 6-month expiration. They might get canned by the seller. Okay, do you think they're desperate to get a deal in front of their seller? As an investor, have you thought about calling the ones that are at 5 months, 5 months and a half? They're up against that expiration. Think about it, what pressure they're under. Go where the data leads, investors, right? Follow population and job growth, tracking migration reports, raising private money amongst people that have money to put in but don't want to get as dirty as you. Building trust by educating your network on real estate. Having meetups, having get-togethers, having workshops. I mean, we're having anywhere between 6 and 8 workshops, like networking events a month that I'm sponsoring. We just announced another one in Stroudsburg, Pennsylvania. They're going to have 200 people there. I'm the key sponsor. This Saturday, we're going to have the white label marketing workshop. I'd love everybody to come down and join us again. We're having it in a different location every month. So we're having it back here in Philadelphia, which I'm really excited about. But there's going to be 35 to 50 people there learning how to broker and corresponding money with a direct private lender, understanding debt service coverage ratio, understanding how to underwrite. These are very important issues for real estate investors today and for real estate agents. Agents, you need to know what a deal really is. It's not happening in your office. They're not teaching you how to identify a deal for a real estate investor. It's just not happening. Brian, good morning. Welcome. Brief overview, who you are, what you do, and thoughts to a discussion, breaking down shifts in the market, mid-year update.
Hey, good morning, Joe. Good morning, everyone. My name is Brian Guth. My wife and I have LG Homes Group here in lovely upstate New York, Rochester area, in between Syracuse and Buffalo. And it's interesting when you talk about the market shifts. We're definitely teetering up here towards going to a buyer's market, but I would say it's still that tick over on the seller's market. It's very interesting. It definitely there's definitely the nuance involved, the different nuance of the property, the type of property, and honestly how the realtor's listing it. What we do up here is delayed negotiations, where it's basically like you put in your offer and it's okay, you have 7 days, we'll review all the offers in 7 days, and they have escalation clauses. The people that are kind of marketing their property at a low number to get eyes on it, getting a bidding war going, they're still killing it as sellers. And I see others where maybe it's a less desirable property or not done up the way kind of I would expect it. And, it's going past the late negotiations, meaning, okay, it's free for all, put in your best offer, even if it's below asking. So it's an interesting concept up here, kind of how things are looking. So I would just, from an investor perspective, just paying attention to the nuances, kind of seeing what those trends are. Kind of identifying which ones I think are not going to go past the late negotiations, which ones really I think are going to have minimal offers submitted, and therefore I have kind of my opportunity to get after it. So, and when I say all that, I'm saying I'm paying attention to actually on-market properties. I still do a lot of off-market stuff through wholesalers or my own leads, but really I found an opportunity on the MLS with some of these properties where the agents just aren't listing them correctly, or their properties aren't done correctly. So I guess even there, that kind of tells you it's shifting more to a buyer's market. But I would say it's still up here in Rochester probably a tick towards seller market. So there's still some really big numbers getting out there for the sellers. Just showing that detail. With that, I will pass it back.
So, Brian, I was on one of your calls for the Rochester RIA this past Wednesday, and it seems like multifamily is still very tight. I guess everybody's holding on to the multifamily, but yet they're bitching about all the regulations that are coming down on the landlord. So, where's the happy middle here over the next 6 to 12 months, governmentally wise? How will the real estate investor look like by the end of this year, based on a lot of the things that are going up in that area of New York State?
Yeah. I mean, it's odd. There's still a lot of wait and see. I think I've mentioned before, there's a thing called a good cause eviction passed, which is very tenant towards a tenant, where it can be very difficult to evict someone. There's still some loopholes there. It's adapting a law that went into New York City. So there's still, I think there's a lot of concern. People are kind of taking it cautiously there. Like for me, I've kind of read through the details, trying to educate myself as much as possible. There's some loopholes out there. It's really driving towards trying to get away from the landlords that are quite frankly, kind of slimy and trying to bump rents by 30% or giving discriminatory ending leases. So I think it's caused a situation where people aren't educated about it and they get scared. They hear the regulatory stuff like, oh my gosh, I gotta stop. Honestly, if you're educated on it, it doesn't seem as scary. The one thing that does jump out to me, I need to check to see where it's landed lately. They were looking to pass a law in New York that said an investor could not buy a market on property until after 6 months has been on the market to basically allow buyers in there. That could have an impact, but for me personally, it's still kind of status quo. There's stuff out there that can be scary, but I found that as you really dig into the fine print, it's not as scary as it's being perceived.
Yeah. I mean, I'm looking at some of the better performing rental markets right now, and markets to avoid for the rest of 2025. So, it's really interesting. I mean, based on signs of rental growth, demand, and long-term, investor upside, still there's some areas outside the Northeast that are still staying very strong, like Tampa, Florida, Dallas, Fort Worth, Indianapolis. I was just there. Probably one of the most boring cities I've ever been to, but it's a low cost of entry, landlord-friendly laws, and steady rental demand. Charlotte, North Carolina, certain submarkets of Philadelphia are still hanging in there. High demand for workforce housing, strong education, healthcare job market. And if you're going to stay in Philly as a landlord, I like West Philly. I like Brewerytown, parts of the Northeast. I was just up at the Man last night for a concert. I saw some things working in your favor. I think there could be an opportunity. Nashville, Tennessee, staying very strong. Cleveland, Ohio. It's an older city. It lost a lot of industry, but it's hanging in there. Underrated cash flow market with solid blue collar demand. Section 8 and cash flow focused investing. But the problem you got with Cleveland compared to a lot of the other markets there is you have a lower maintenance management presence there. Just not a very good one. I'd be concerned, from an out-of-state landlord perspective. Now, some markets I'd be cautious about, and it's funny. I was talking about San Francisco with a friend last night. She owns a property there. I was telling her you should get out to sell the property. High vacancies, rent control, remote work impacts, and poor OI. New York City, terrible. I'm doing some business still, more bridge, but it's not a long-term rental market for the inexperienced. Portland, Oregon is pretty tough. Chicago, Illinois is still very tough. A lot of lenders are avoiding it. Austin, Texas, I think this is more temporary, but I think there's an oversupply of rentals and apartments. Flat to declining rents. I'd revisit Austin probably in 26. Phoenix, for now, overbuilt multifamily market, cooling rent growth. Some professional investor tips. to think about, watching migration patterns, leveraging midterm rentals, using debt service loans smart. Focus on markets that your debt service is over 1.2. And I mean, you got to look at your cash on cash return. Focus on landlord friendly states, of course. It's tough when you're in certain states that are not so friendly, especially with rising eviction protection laws. I would also, as a real estate agent or a real estate investor, why aren't you partnering with more property managers? They know who is tired. They know who wants in. They know who wants out. They're boots on the ground. I have had probably a half a dozen meetings over the past quarter with varied property management companies. And they want to have meetings with me. They want to see where the lending is going for their current landlord base and for people they're taking on as clients. Are they solvent? Do they know what the heck they're doing? Will real estate inventory increase for the rest of the 2025? I believe it will. I think it's expected to gradually increase through the remainder of 2025, though this trend will vary by region and property type. Couple the reason why I think the inventory is going to increase. I think interest rates are going to kind of stay where they are. I went to a luncheon this past week with somebody that's I feel like is a very smart, savvy real estate investor. He feels, and I do agree with him, and we agree with one another, the rates are going to be within a half a point of one another. Probably for the rest of the year. I think distress and foreclosures are slowly rising. I think builders are completing projects and not taking on new ones in the same immediate market. I see a lot of developers moving out of a lot of the urban cities. They can't sell. They can only build to rent right now. So investors are offloading underperforming assets. I'm seeing a lot of inventory being sold to the housing authorities throughout the country because they want out. Some of these investors within the cities. How this will impact, real estate investors is more deals to choose from. Motivated sellers equal creative finance. Flipping margins may improve. And some of the risks you need to keep in mind is rents are flattening in some markets, or rent will just growth stall altogether, and holding costs go up, right? So you got to have a deeper discussion with property management or maintenance groups. And how will this impact the agent? More listings equal more listing agents needed. More investor clients. Expired and FSBO prospecting gets stronger. Some of the risk, longer days on the market, more work per deal. And then there's commission pressure. Some winning strategies I think you got to keep in mind is target properties with motivated sellers, expand with midterm rentals or Section 8, negotiate harder. For agents, sharpen your listing presentations. Building investor buyer lists, and prospecting builders, expireds, and absentee owners. Ed, good morning. Thanks for coming up. Brief overview, who you are, what you do, and thoughts or discussion, breaking down shifts in the market mid-year update.
Morning, Joe. Ed Dowling. Right now I'm a licensed referral agent with Remax. Yesterday I was at a seminar and they were talking about residential assisted living, investing in those properties, which is something new to me. I don't know if anybody here has any interest in it. I mean, talking about smaller properties with maybe 16 to 20 residents. The cash flow in those properties is amazing. What they pay. I mean, you could. You buy the property and then you lease it out to these operators who, for residential assisted living. I just wanted to get your thoughts on that, Joe, if you know anything.
Yeah. So, I mean, the landscape for the rest of the year, are we talking about just like single family home conversions into assisted living residences? 1 through 4.
That 3 to 4 bedroom.
Yeah.
Or bedroom.
It's called a RAL. It's called RAL, RAL, residential assisted living. A lot of them, they have to comply with a lot of local licensing and building codes. I don't think the townships or communities are against it because they find that more favorable. There's less noise in those homes in the sense that there's just more eyes on the building, the property, because of the care. Wheelchair ramps, grab bars, wider doorways, non-slip flooring, fire safety systems, making existing homes safe and accessible. And then you got your zoning and permitting challenges. Most jurisdictions require compliance with single family zoning or group home rules. For example, up to 8 elderly residents with a staff as a single family use is limited. Extra, and it also provides a need. It creates a need for extra restrictions. So the people that are selling that idea don't talk about the jurisdictions and the zoning changes and the expense to set the property up. But you could do that during the renovation, right? Some state, it's almost like an ADU. You got to look at some of the ADU laws as well. Market demand and supply gap. The U.S. needs hundreds of thousands of new senior units by 2030, right? An estimated gap of 370,000 units, and routes are emerging to bridge that gap. High occupancy. You got 90% major metro markets. Scarce new supply make intimate home-based options increasingly attractive. So saying that, yes, it's nice to say, yeah, this is a good way of making money, but they don't talk about it. Say your renovation costs on an average home like that is $50,000. The renovation on making it a RAL is going to be $150,000 because all the showers and the bathrooms and the kitchens and the ramps, you're spending a lot extra money. And now you also going to have an on-site potential nurse at a certain number of seniors living in the property, right? Am I correct, Ed?
Yes, you're correct, Joe.
Okay, and you're going to have turnover. As you get older, people die. So, how do you facilitate that? What's your maintenance look like? What's your ongoing maintenance? What's your ongoing management? You need to find a management company that knows how to handle that, right? It's very personalized care and wellness focus. The tech also is very important. The monitors, telehealth, AI sensors, smart home automations are going to be very important in this. And then if you have to adaptive reuse, what if it doesn't work and you got to put it back to a regular home? Now you can spend $100,000 to bring it back to some form of normalcy for a family to buy, right? So it sounds good, but I think there's a lot of consideration on the cost. It's higher than a regular property to maintain. There's regulations, and then there's issues, right? Is there a value for this on the back end in the market? How do you value that property? You can't base it on income because it's unforeseen income. You don't have a 12-month trail housing seniors, right? So now you got to base it on the market. Is there enough room in the deal to make that cash on cash back return, right? I'm not disagreeing with you. I'm saying that my concern.
No, I agree with all that, Joe. And I didn't say it would be easy. I just said that if you look at the returns, they're there. But you're right about all the things you had to do. And now the senior housing is a protected class. Seniors are, so you can't discriminate against them if you're coming into the neighborhoods and stuff like that. But you still have to adhere to all the zoning and things like that.
Yeah,
and I brought that up to them too.
Well, listen, everybody has a plan until they get smacked in the head. You know what I mean? So it sounds good. They're probably trying to raise money for their own endeavors for the people that were in the room. Let's be honest. I know what kind of room you were in yesterday. So
no, they were trying to sell. They were trying to sell a course.
Yeah, of course. Okay. So the course. I just gave you the course. I just gave you all the.
Yeah, I know.
I just gave you the course. I saved you how much?
I think they were selling for like $5,000.
Okay, so I just saved you $5,000 for half a nickel, like Amy says. I gave you the down and dirty concerns that you should have looking at this. So some key takeaways that make sense, right? close this, you got to look at what the cost is going to be with a contractor. Now, will that justify the after repair value, since you will not have a 12-month P&L on future endeavors to that project yet? So if you can't use a pro forma to come up with a new value based on income approach. So it's got to be solely on the market approach as well, right? I love it, the idea, the wellness, the personalized care, but is it going to be cost effective? And who's going to be the management company managing the on-site management company? And then you got to always be concerned about zoning and licensing barriers, state rules, county rules, compliance with building, fire, and healthcare regulations. Did they teach you all that in that $5,000 book?
I don't know. I don't think the state and the county. I think you have to worry about the local municipal. Yeah, especially if you're in all these small little towns, they all have their own little zoning regulations and things like that.
I'm starting to see more build outs in the last year of senior housing than ever before. Like I'm seeing a ton of 55 plus build outs right now in the surrounding area. I've seen 4. That's a lot, in the last 12 months. So I don't know how the small house will make out. Like not a small house, but a 4 to 8 bedroom house work out? Will it be cost effective, or you just kind of, the idea sounds good. It sounds good in your heart too, but will it make money?
I think the money is doing in the bigger ones holding 16 to 20 residents, 25 residents. That's where I think that's where the money is, not in the smaller group. They're called group homes. My father had one living next to him. They're great neighbors. You don't hear anything out of them, But like you said, there's a lot of things go into it. It's not
as easy as everybody thinks. They're selling a book. They're selling a workshop, and you got to be concerned with that. And you got to be in an area where it's favorable towards seniors. I think the urban settings are going to have a hard time with that. But then you're also going to have a hard time for overhead in the suburban markets. I mean, I feel if I was going to do this, I would do it more in a rural setting, somehow connected within 10 miles of a hospital, because I think that would be much more cost effective. But it's going to be a long-term play. You're not going to make a lot of money the first year because it's all going to be in the deal.
Right. Yeah.
Ed, thank you as always.
It was easy. I just brought it up if anybody knew anything other more about it.
But for $5,000, they're going to make it so much more easier than what I did, right?
No, I'm not. I had no intentions of $5,000.
Well, I appreciate your time up here, Ed, and thank you as always.
I want to jump in on this. This is Travis.
Travis, go right ahead. Good morning. And by the way, I do enjoy that picture of you eating, looking like a delicious beef rib on Facebook. It was a very dirty picture.
Oh, my God. It's a Wagyu beef rib smoked from one of my favorite barbecue places in Houston.
Sounds terrible.
So good.
So what's going on?
So one of my really good friends, he's been in this business that you're talking about now for about 20 years. And he owns, I don't know, we'll say like 40 units of what you're talking about. So he and I, we looked at what they were valued at. This was during COVID, and this was probably 4 years ago. And so, yeah, it's hard to value the properties once they're up and running and you have residents living in there. But what he was getting values on when he was going to the bank to do a refi on one of them. So they were valuing them at $100,000 to $125,000 per bed. So that was 3-4 years ago. So that now what he has are 3 and 4 bedroom houses. Then he has like a 16 unit, 1-story commercial building, and you have restrictions on how big the room sizes are to how many beds you can have in a room. So if you have a normal sized bedroom, you can only have one bed in a bedroom. If you have a 200 square foot room, you can have two beds in a bedroom. And I mean, it's not, he runs the whole thing, right? He's got the nursing staff. He's got, he does all the marketing for the assisted living centers or the assisted living buildings that he has. So it's not like you just go buy a house and turn it into one of these assisted living centers. It's not that simple. So, you know, what Joe's talking about as far as like what you have to do to get it ready, there's a lot you have to do, and you have to know some of those restrictions, right? So how much square footage can you have per room? How many beds can you fit in that room? You have to put in the sprinkler systems in the properties. You know, you can't just buy a house and rent it out as is. It has to have one of those sprinkler systems in there. At least here in Texas and in the Houston area, you have to have that. But yeah, it makes him a lot of money, man. He's like semi-retired now, and he still has, you know, whatever, 40 units of these things. And I've talked to him about building more and just selling the buildings and letting him run the business, or his business run the business.
Yeah.
Because you have to have the healthcare professionals in there. They don't necessarily have to live in the unit, but they have to be there 24/7. But it is a moneymaker, I can tell you that.
I just can't imagine the fit out cost compared to just a regular. Like, so say you gut a house to the studs, right? There's no way a town's not going to they're going to, a sprinkler system, all the electric, the wheelchair accessibility, all the door sizes, that all has to change. So like you need a contractor that knows how to do all that. That's a regular GC doesn't understand. I can't imagine that not almost doubling your costs or tripling your costs. So you buy something for 100 and now you're into it for 150 instead of 100. Or even 200,000, right? So you're at 300 grand, and the market only bears a 300 grand rent up value, or 325. So you're in it at 90% LTV. So you're gonna have to leave money in the deal because there's no comparatives to the value of the house based on the approach that you're doing. Now, then you got to obviously fill it, maintain it, get it to a cash flow perspective. Then It doesn't work in a year to 18 months, or the guy retires. This guy, he's ready to go, right? Somebody has to take that property. What if somebody doesn't want to buy it the way it is and they want to put it back to a regular, home for their kids and themselves? Well, somebody's going to have to spend 100 grand to bring it back to normalcy, right? You got who wants sprinklers in their house?
I guess, but you gotta think though that the people that are buying these living homes, he calls them assisted care cottages. That's what he calls them.
Yeah.
They're buying a business. They're not buying this stuff for another rental house.
No. He's going to sell that off.
Is in the beds, right? So if the value back then was 125,000 per bed, and the real estate value is probably only whatever 300,000 to 400,000, right, for a 4-bedroom house around here. The value is in the bed. So if you have 5 beds in a 4-bedroom property, what's that? 700 and whatever, 125 times 5. What does that come up to?
125 times 5, that's 250. That's 700 grand, say roughly.
Yeah, so it's valued at 700,000 as a business. That's the value. It's not so much the real estate. That's where the value is. So yeah, would it be hard to go to a lender like you? Yeah, because you don't know how to fund that. So you have to go to a normal bank.
Yeah.
So
well, they want to see the deposits. They're going to want to see the deposits. They're going to, listen, eventually that gentleman or somebody like him is going to sell it off to a corporation or a hedge fund.
That's exactly what I was talking to him about. It's like, Buck, let's let's build more of these things, bundle it together, and then sell it to a freaking hedge fund or a private equity firm.
You would have to go to the SBA too, also, to get funding for these properties.
Yeah, you could. Yeah. I had investors that were ready. Like we were going to buy land or buy a property cash and then do all the rehab and then let him fill it up and run the business. And we were just going to own the real estate. So you're going to partner with them.
So do you think you guys, you think over the market shift in this with the inventory moving up and rents getting a little stagnant, do you think the creativity is going to increase in the senior market in these type of unique concepts? Because obviously we have more seniors than ever before. And I feel like short-term rental is kind of running its course, and mid-term rental, depending on where you're at, is going to run its course out as well. So you're telling me you think, for the rest of this year, maybe we should look at like this is totally off the discussion. I didn't see that we're going this way, but you think the senior movement might become more prevalent over the next 12 to 24 months, even more so?
I think so.
Travis, is your market aging fast in Houston? Are you getting younger? Is it getting younger or getting older?
I don't really know. I know that in my area, where I live in the Woodlands, it's aging.
Yeah,
we're not getting a lot more young people, but we don't have any new houses you can buy either. So the young people that come in, they're in apartments, but we're definitely aging.
Yeah, the affordability. And I think the seniors are going to get priced out of the 55 plus communities, and this might be a very viable option, but the concern I have is who's doing the construction contracting for this? What's the zoning and regulations look like for this? And you're going to have quite a bit of money into the deal before you see a lot of cash on cash return. And I feel like the exit strategy is selling off to a corporation. Either way.
It is, or someone else that wants these things.
Yeah. And
but
go ahead.
What Ed was saying, what was I just going to say? Anyway, it is a good strategy, but it is something that, this is what I was going to talk about. Because I asked him, like, how are you, because some of his care cottages are in like HOA subdivisions, right? Like just a regular residential house. I was like, how are you getting past that they're allowing you to do this? And it was just like what Ed said. He said, yeah, it's senior housing. They can't discriminate against us having this type of a building or this type of property because of their 65 and older communities or 65 and older residents.
They're a protected class.
Yeah, exactly.
So you can't discriminate against them with that.
Right.
With these... Is you market to not the actual patient is the children who are paying.
Yeah, that's right.
And they don't want to put their parents in these big box nursing homes with 300 beds or whatever. Because you don't get the care that you need. They said it was like for every 30 patients there was one nurse. Where these smaller ones get better care and they're willing to pay, either out of pocket or with long-term insurance policies.
That's right. And I think right now his minimum is $4,000 a month for a shared bedroom. That's what you would pay.
Wow. That's big money.
That's a lot.
That's a lot of money.
So you're getting, 3 bedrooms, you're getting, $15,000 a month, $12,000 a month.
I mean, and that's cheap because it's funny. We have an elderly relative that they looked at a privatized one. It's $7,000 a month.
Oh my God. Yeah.
Yeah, and those likely the insurance is paying it, or these people are paying it out of, it's not. We're not talking about making it for Medicaid. This is all private. It's all private money.
That's crazy stuff, man. I mean,
if you get into it, you definitely need someone like him and his business to run that side of it. Because there's so much to know in what they're doing.
Yeah.
There's two parts to it. There's the real estate part to it, and then there's the business part.
Yeah. And that's where the SBA comes in down the road. And I'm not an SBA lender. I usually refer to or recommend to somebody that I know very well in SBA. I like the idea. It's a lot of work, and you got to have a lot of cash on the sidelines or you already have the inventory, and it's just a matter of getting the properties in line to regulation in that community. So I don't think anybody's going to get anybody's way. I mean, nobody wants to be in the elderly's way of living, and I think because of COVID, I think children of parents that are aging do not want to put them in a senior community where they get trapped and they can't see their parents.
Exactly.
I think that's really the underlying reason, because those places will not allow somebody to come into the place in a regular home. They can't be stopped. You know what I mean?
Yeah.
So I think it's the COVID movement that's pushing this agenda. I think that's because of what happened and what was cut back on everybody.
You're exactly right. That happened to a friend of mine. They wouldn't let him see his father. His father ended up dying, and he was not allowed to go and see him for during COVID.
Well, it's learning lessons. So I appreciate both you gentlemen this morning. I'm going to put some final thoughts to this. As we hit the midpoint of 2025, the real estate market is experiencing a transitional period, not a crash. And savvy investors and agents are going to pivot, not panic. I keep telling people when there's chaos, there's opportunity. And key themes of defining the mid-year market: inventory is rising slowly but strategically, right? Affordability is still the number one challenge. Financing is the new frontier for most agents because they don't know what non-QM is. And a lot of investors, funny enough, are just getting their head wrapped around non-QM. The power is shifting back to the buyer and the investor. For the first time in several years, the buyer has leverage in many markets, especially in the tertiary cities or overbuilt submarkets. There's longer DOMs, price drops, and more seller concessions are creating a rare window. Success in 2025 equals adaptability. Agents and investors who are data-driven, relationship-focused, and creative in deal structure are thriving. Those who cling to the 2021-2022 playbooks are going to lose a lot of deals and sit in a very stale inventory. Bottom line, this is not the top and it's not the bottom. It's a strategic middle where those who adopt will quietly stock the best deals for the next 5 years. What do I think a real estate agent should do? Re-engage with past sellers, price appropriately, build your investor buyer list, double down on prospecting. For investors, underwrite deals better with higher expense buffers. Negotiate creatively, sub-2, seller finance, rate buy downs. Look for mismanaged assets with upside potential. Bob, your final thoughts to our discussion, breaking down shifts in the market mid-year update.
Just kind of thinking of what Ed and Travis are bringing up here with the senior housing. That is definitely a market that we're going to see more developing, and it's becoming an issue in certain parts of the country. Parts of Florida and Arizona are definitely having issues. The state of Delaware as a whole is becoming very attractive to seniors because of the low taxes, although with our current governor, God only knows if that's going to last much longer. Little editorial comment there. And did I say that out loud?
Yes.
Anyways, and the other one is Scranton, Pennsylvania, which has one of the historically oldest populations in the country. I think at one time they used to be second only to St. Petersburg, Florida. And that is another market where a lot of people just age, they try to age in place, but it's very institutionalized senior centers here. And I learned that more and more from personal experience over the past year. I do not want to discuss that publicly if everyone doesn't mind, but suffice it to say, I got to see more than my fair share of the insides of those in the past year. And they're not just, they're depressing. And people do want other alternatives, but in a lot of markets, the other alternatives don't exist. So, if you're looking at new strategies and new investment things, yeah, obviously you heard there's a lot to do with it, but it is a valid market and valid concern. Those are my thoughts on that. Back to you.
Bob, Travis, Brian, Ed, I want to thank you for your commentaries this morning. This was a great discussion on breaking down shifts in the market mid-year update. I want to thank our sponsors. I want to thank Mr. Yardell Perkins of Perkatech, providing all our social media and video production. I want to thank Ms. Linda Pelagas of Realty 411, a national publication and national event planning for real estate professionals throughout the country. Lenmark Capital, providing nationwide asset-based lending, non-QM, for real estate investors. I'd like to thank MB Capital Solutions, where I'm a referral partner in the Unsecured Business Lines of Credit program. I'd like to thank our new group that's running all these events throughout the tri-state area or quad-state area, Real Estate Mastermind Strategies, and then where my licenses are held, TCS Property Management Services here in New Jersey and PA. We have a great white label course coming up this Saturday, from morning to mid-afternoon in Philadelphia. If you want to come in, fly in, come in on a Friday and stay till Sunday. We're going to have a great time networking, educating one another, underwriting, white labeling, setting it all up, getting you to be the better broker, working with a direct private lender. That all by itself. And then we have breakfast. We have a nice light lunch. We're really going to dive into the educational piece heavily to make you a better real estate professional. And I want to thank everybody for this past week. A lot of the events I was involved with in sponsoring and representing Lenmark and myself there as a lender. My quote this morning: 9 habits for success. Plenty of sleep, eating healthy, staying active, going outside, meditation, accepting failure, asking for help, losing your ego, and removing toxic friends. Everybody have a beautiful Sunday morning. Have a great week. Listen, these moderators put some time in here, man. This was really great insight. Reach out to them. Have a one-on-one. Discuss things with them. We're here every Sunday morning, 9 a.m. Eastern Standard Time, providing education, networking, and strategy. I want to thank everybody again, and I'll be ending the room in the next 30 seconds. And thank you.